Hey everyone, I have a great video for you today. I am going to share my top 12 favorite dividend stocks of all time. I have been investing for over 20 years, and the stocks that I'm going to share today are the culmination of my decades of investing experience. I have 12 positions in particular. I'm going to go through them one by one. For each position, I'm going to share an overview of the financial metrics. I'm going to share reasons why I love that particular stock and why I own it personally. And I'm going to share some risk factors because any single stock holding that I own in my dividend stock portfolio, it carries risk. And so I like to be well aware of the investing risks. Now, as I go through the stock positions today, I also have some really cool props that I'm going to share in the video today, like this one. So it's going to be a fun video. I'm going to have the props to keep it fun. And what I like to call these top 12 holdings of mine that I'm sharing today are called my ride or die stocks. These are literally the dividend stocks that I will ride with. I will ride with forever. I will never sell them. I will keep adding to them, and I love them so much. And I think by the end of the video today, you will see why I love them so much. Now, before we even get started today, I encourage you to please hit the thumbs up, that like button, if you're excited about dividend stock investing, if you appreciate my videos here on YouTube. That means the world to me. Let's get started with today's dividend investing video. All right, everyone. So stock number one is Johnson & Johnson, ticker symbol JNJ. Now, I don't have any cool props for this particular stock. I'm sure I've got some stuff around the house from J&J. In fact, I know I do, but I didn't take the time to dig it out before the video today. But I do have some really cool metrics to share, so I'm going to put those on the screen right now. So check it out. Now, this is a quick snapshot of J&J. I'm not going to go into the metrics in too much depth today because I've done this in so many videos in the past here. But the one thing I do want to highlight is the forward PE, price earnings ratio, for 2021 is a 16.51. And so one of the things that I love about this particular stock is that it seems to be perpetually trading at a reasonably good valuation. It's not overvalued. It's trading at a fair range, if not a discounted range, compared to where the overall stock market is. Because right now, in the middle of this global pandemic, for whatever reason, the stock market is surging to new highs. I believe some of that is because of the amount of money that has been being printed by the government right now. And I think people are moving into stocks as a hedge against future inflation. So that's probably one of the reasons, at least, that the stock market is surging. But nonetheless, even in a surging market where most stocks are fairly valued, if not richly valued, overvalued, J&J seems to be trading at a reasonable forward PE on 2021 earnings of 16.51 and on 2020 earnings of 19.31. So certainly this is a stock that I feel is in a fair range right here. Now, in terms of the top reasons that I love this stock, I'm going to share them on the screen as well with all of you right now. I love this stock for so many reasons. First and foremost, this is a highly diversified company. By owning Johnson & Johnson, I have exposure to pharmaceuticals, I have exposure to medical devices, I have exposure to consumer products as well. And so it's a widely diversified company. Something else that I love about Johnson & Johnson is literally in any kind of economy, a good economy, a bad one, quite frankly, like we're facing now, everyone is going to invest in their health care. People do not want to shortchange their health. Health is the most important thing. It is more important than anything. And so Johnson & Johnson is at the forefront of that. That's one of the reasons I love the company so much. I also love this company because they are successful in making acquisitions. So many times You've probably seen this if you work in the corporate world. Companies make acquisitions, and they make acquisitions just to later write it off. And I've seen this so many times, even with stocks that I own in my portfolio. I own 46 different dividend stocks. I'm highlighting the top 12 today, my ride or die positions. Quite frankly, I could own these top 12, and I don't really care about the rest. Look, I do care about the rest, but these top 12, these are the ride or die positions. But I've seen so many companies make acquisitions, later just to find that it was a bad acquisition or it was an overpriced acquisition. Now, the beauty of Johnson & Johnson is they have grown into a global, huge healthcare company that spans so many different facets of healthcare, and they've done it through acquisition. They've done it successfully. They have a secret sauce for making acquisitions, integrating acquisitions, and having it all work out. And I love that, because so much of the time it is easier for a company to grow through acquisition versus organically. So I also love this company because it is a dividend king. They have raised their dividends for over 50 consecutive years. And so this is a company that is shareholder focused, that really cares about rewarding shareholders with an increasing stream of dividends over time. So whereas the starting dividend yield is only 2.7%, the opportunity for a yield on cost, a higher yield in the future, is there, because they tend to raise the dividend every year, and they've done that for the last 50 years. Also, this company is very consistent in its revenue and earnings growth. It has strong margins. It has an 18.4% net margin. And it's not the kind of company that is get rich quick. It's not the kind of company that you see the earnings surging and catapulting. But it is the kind of company that provides stable, predictable earnings growth over time, which is just what I want to see as a long-term investor. I am in this stock forever. I don't need to get rich quick overnight. I would like to get rich slowly and incrementally over the years with stability and a minimum of volatility. Why else do I love this thing? I believe, as already mentioned, it has a really reasonable entry price-earnings ratio as compared to where the overall stock market is. So obviously not everything is good about Johnson & Johnson. What are some of the reasons that I don't like the thing? I will tell you, there are 3 reasons, and they all come down to legal risk. Legal risk, and legal risk. So if you have been following the financial news, you have probably seen in the last year or two that there has been a lot of drama pop out around Johnson & Johnson, and sometimes when it does pop up, the stock will go on sale and create a buying opportunity. Now, the first piece of drama that tends to surface is this controversy around their talc powder. Around the talc powder, allegedly, there is controversy and a belief by certain consumers that there may have been asbestos in the talc powder. And so this is something that Johnson & Johnson has been attempting to get to the bottom of. They have been successful so far in basically defending themselves, and they believe that there was no asbestos in the talc powder, but certainly that is a huge legal risk, and it is something that has been popping up over and over again. Now, even bigger than the talc powder, however, by the way, and the talc powder is used in their baby powder. And so this is a product that they have sold for many years, many decades. And even going back in time, certain consumers are alleging that there may have been asbestos. And so the court of law will tell, the jury is out. We will see how they continue to handle that over time. But again, so far, I believe that it has overall been solved successfully. Now, before I go a step further, as I always do in my videos, I just want to be very clear that my heart goes out to anyone facing any kind of medical situation, and I don't want to make light of your situation, and I care about you, and I wish you all of the best. I'm simply commenting here on the news and what I see out there in the investing landscape. And so again, it is up to the court of law to ultimately determine who is right and who is wrong as it pertains to these issues. But so far, it seems like things are going in J&J's favor. Now, perhaps an even bigger litigation risk than the talc powder is the opioid crisis. There has been some news that I have seen in the last year that certain parties out there are alleging that Johnson & Johnson is in part responsible for the opioid crisis. And I don't need to get into all the details as to how they may be responsible, but that is what they are being alleged. That is what is being alleged against them. Now, obviously, J&J is defending themselves, saying that they are not responsible for the opioid crisis. Ultimately, however, the opioid crisis has cost the U.S. health system a lot of money, and I think there will be certain companies, certain players that are investigated, and it will, over the coming years, it'll be very interesting to see how it all pans out. Certainly, there is a legal risk there for J&J, although, again, so far, at least as of right now in 2020, they have been doing just fine against these legal risks. And again, the third bullet point on the risks literally is just more litigation. Litigation, that is the name of the game. That is the risky thing in the health sector. And it is so difficult. It's difficult being in this sector because these guys have to constantly innovate. The patents, for example, on the drugs that they produce, they only last so long. They have to keep innovating. But in that innovation, they're trying to solve major health problems. And they're trying to bring products to market that solve major health problems. But with each product that they bring to market, there's always risk because every human is different. And if a human takes a certain product, a certain drug, and it backfires or it goes the wrong way, who is at risk? How does that pan out? And so there's a lot of legalese with this industry. Investors like myself need to be aware of it. So I spent a lot of time on J&J. I had to do it because it's my #1 favorite stock of all time, but I've got 12 of these to go through, 11 more, so I've got to speed it up a bit here. And so I'll do my best to keep on track. The #2 stock in my ride or die stock list that I want to go through is PepsiCo. I love Pepsi. It's my #2 favorite stock of all time. And did you know Pepsi, it's not just Pepsi-Cola. Pepsi owns so many different brands, not only in beverages, but in snack foods as well. They own Frito Lay, which is such an amazing snack food and chip company. Now, with PepsiCo, I actually do have a prop to share with you. You may not know, but I don't know if you've had these before. It's called Izzy. This is a carbonated, like, fruit juice beverage. They're only 90 calories each. I really like these, and so I've got one here. But this is Thug Life investing. I don't go small here. I go big. And so I got something to share with you. Here's the, let's see if I can lift this up. Here's the entire case of Izzy's from Costco. A bunch of them here, and I've actually got a few of these cases. Now, I mostly drink water, but when I do kind of break my habit of water, what I will do is I'll actually drink a bubbly sometimes. This is a carbonated water beverage from PepsiCo as well, but I will reward myself with an Izzy from time to time, or obviously coffee. Coffee on all day, every day. It's how we do it. We'll talk about that later. But anyways, what I'm trying to illustrate here with PepsiCo is it's not just Pepsi-Cola. They have some really cool other brands as well that are taking off in the marketplace. And one of them that I'm not showing now, which I wish I had a sample in front of me, was that bubbly water taking off in the marketplace. And I love it. All right, I'm going to share some metrics on the screen right now. Check it out. And so with PepsiCo, the main thing I want to highlight, again, I don't have a lot of time to dwell on all of the numbers today. You can see them there on the screen. I spent a lot of time preparing for this video so that I could optimize your time just by showing the numbers on the screen right now. But the main thing that I highlight here is 3.1%. Getting in at Pepsi here, yeah, it's richly valued at a high PE, but despite the high PE, in the climate we're in now with really low interest rates, with governments printing money as fast as they can, what is so exciting to see is a solid starting dividend yield on my #2 favorite stock of all time. And so I am buying PepsiCo now. I like it for that very reason, is that it's a good entry yield. Although I'm not kidding myself, it is richly, if not overvalued on a PE basis. It's not a bargain here. It's not on discount. Maybe J&J, we could say it's a little bit on discount right now given the overall market. PepsiCo is not, but I'm fine buying it. And so I want to move in now into the reasons why I love this stock so much. It's funny, I wanted to just do top 3 reasons I love each of these companies, but it got into more than 3 because I couldn't stop at 3. But with PepsiCo, as I mentioned, they own Frito Lay. Frito Lay, in fact, is the main reason that I own PepsiCo. I don't drink Pepsi-Cola. Their beverages, I don't drink any kind of soda anymore. I drink, well, Izzy, I guess you could kind of call a soda. I have it once in a while. But in terms of like a soda like COCA-COLA or Pepsi-Cola, I don't drink that kind of stuff anymore. But anyways, the reason I own Pepsi and I love it, it's not even because of the beverage business. It is because of Frito Lay and the snack food business. They are golden. So I also want to illustrate that you may not know, but PepsiCo recently launched snacks.com. They also launched something called pantryshop.com. These are direct-to-consumer websites where they can go and sell their products, not through a store, but directly over the internet to customers. They bypass the middleman, so this is not through Amazon. This is directly from PepsiCo, and I love that so much because they're thinking innovatively on technology. And I live in the Silicon Valley, spent many years working in technology, although now I'm in real estate, although I do still work on a lot of tech stuff in real estate. But a lot of talent is being hired at PepsiCo. And in particular, there's one very bright gentleman that I know they hired, who I am a huge fan of, who I am friends with on LinkedIn, who I worked with at a past company, very bright engineer, leader, a CTO type person, and he got hired up by PepsiCo, gave me a lot of confidence in the company recently. Why else do I love them? 47 years of dividend increases. We'll get close to that dividend king status really soon. Talked about bubbly sparkling water and other innovations, and we talked about the entry yield. And so obviously, as with any company, there are risk factors. Now, one of the biggest risk factors, and I think they are ahead of the curve here, but it is the fact that consumers these days are trying to eat a little more healthy. Consumers these days, they're starting to think about their health. And quite frankly, they're doing this because of this nasty pandemic, but it started before the pandemic, but now we even know at the pandemic that there are reports that weight is a factor. It's a factor with this horrible virus, and the more lean someone is, the better shape that someone is in, the better chances that they have against the virus. But even before that, we know that there's this health conscious movement where consumers, they're just trying to be a little more healthy. And so PepsiCo, being the type of company they are, has to stay ahead of that. Now, I would say that they have done a fine job staying ahead of that so far, but time will tell if they can continue to do that. I mean, one of the first innovations out of PepsiCo was literally just the baked Lays, and I think that was many, many, many years ago. But even since then, some of their portfolio they've been building out in the snack foods division, getting a little bit more healthy. And they've been working on this for years. And I know even in their annual report, they differentiate sometimes between kind of the more junkier foods and the healthier foods. They try to have a balanced portfolio because sometimes consumers, they want to maybe pig out and enjoy something, thug lifestyle, a little more salty, a little less healthy. Sometimes they want to go a little more healthy. And so PepsiCo's got something for everyone. But I would say also a risk factor with PepsiCo is legal. We already talked about this with J&J, but with Pepsi, I just start thinking, could some court of law, some lawyer out there say, hey, Pepsi, you're responsible for obesity. You're responsible for poor health habits across America. It's just the society we live in. We see this kind of stuff, and I see the blame game out there. And so I just got to be realistic, eyes open. Why am I sharing 12 stocks today and not just one? I like to diversify because any one stock contains risk. And as with Johnson & Johnson, there is some legal risk with PepsiCo. Now, the third risk that I want to point out with PepsiCo today is the pandemic. PepsiCo used to be a huge sponsor of sporting events. I think, in fact, they were like the main sponsor of the last Super Bowl. I remember there's like the Pepsi-Cola Super Bowl halftime show, and they used to be a huge sponsor of amusement parks. But we know right now during the pandemic, amusement parks are not open, and we know that sporting events are not happening. Now, the earnings at this company so far have done really well. They've done well just through the pandemic. People are eating all the snack foods and cola at home, sodas at home, all of the great products that Pepsi makes. That being said, I would say from a marketing standpoint, from a positioning standpoint, Will there be ramifications in the future of not having these sporting events, not having these opportunities to market in amusement parks? We shall see. I hope this pandemic gets resolved pretty quickly here, but if it doesn't, if it lingers on, there may be a lagging effect and it may hurt Pepsi in some ways, although I probably think they will be just fine. All right, so third favorite stock of all time, dividend stock, it is McDonald's, and so I'll share it on the screen right now. Now, I don't have any props with this one. I wish I did. I actually was going to bring my son's Trolls. He recently collected the Trolls from the Happy Meal toy. I did a video on that recently, a whole segment on that, which was really fun. I'll link to it in the description below. I had my son on the video with me. It was a lot of fun. And so as I was setting up for the video today, I forgot the Trolls, but really cool props I could have had for McDonald's. But anyways, check out the metrics. And what you see with McDonald's right now, quite frankly, is I don't highlight anything in the metrics because it is fairly valued, if not overvalued. This thing is trading really high right now. I'm not buying it anymore. I was buying it earlier on in the months of, say, March, April, around then, when things had plummeted due to the pandemic, picked up more shares, a larger position in McDonald's, but right now I feel that it is fairly, if not overvalued. But it's still in my top 12 because obviously my top 12 has nothing to do with current valuation, and it's all about quality. These are the quality stocks, and just because something is a bit overvalued right now, I don't have to add to it right now, but when it does get to a more reasonable valuation, I will add more. And so with McDonald's, the things that I love so much about McDonald's are the incomparable real estate portfolio and successful refranchising. So I get this question all the time. I have a private Facebook group. I'll link to it in the description below. Feel free to join us. This is Dividend Investing for Everyone. This is a free group, although I do ask people to answer a few questions before they join the group. And one of the things, the questions I get on there all the time is, Ian, I noticed that McDonald's revenue a few years ago went down, and so company's not growing. But that is not the case. What they did is they did this thing called refranchising. They took company-owned stores and they basically sold them off. They shifted them off to franchise owners. But what McDonald's did is they retained the real estate. And so the store itself, the property itself, it's owned and it's operated by a franchisee. However, the actual real estate underneath the store and the building, it is owned by McDonald's. And so what's interesting is now that the revenue comes in, the top line revenue, it's recognized at the franchise level, but McDonald's gets rent. They collect rent and they collect franchise payments from the people that are running the business there. And so that's what then comes in at McDonald's. And so therefore rent or revenue at McDonald's looks lower, but actually the earnings have surged. And that's because the franchise owners, they typically run the restaurants with greater efficiency and greater success than McDonald's corporate. And so McDonald's corporate realizes what they do best. And so they've refranchised. And so, again, revenue that would have been recognized all the way at the top level at McDonald's is now recognized at the franchise level, which McDonald's doesn't report on or doesn't see flow through to their income statement, but they are collecting the rent from that particular location, and that's what shows up on their income statement, and the margins have expanded. And so revenue's down, but margins have expanded, and again, the franchisees are doing a great job running those stores. And so I love that. And what I love is they have an incomparable real estate portfolio, and they're smart. They don't just go sell off the real estate. They retain the real estate because the real estate is one of the strongest things about this company. Yes, I do believe that their food is really good. It is really tasty. It is comfort food. But what is even more comforting to me as an investor in McDonald's is the real estate portfolio. And so what else do I love about this company? I love their technology investments. They've bought a few different artificial intelligence companies, and they made an investment in an app company just within the last few years. And so McDonald's is all in on the automation game, all in on making sure that the selections and the food items are personalized to the different consumers that are coming through, and that each consumer coming through a McDonald's location has the best possible experience. And McDonald's is doing that through technology, and they will increasingly do that through technology over time. I believe they opened a Silicon Valley office in the last few years. I love that. Any company these days that is not investing in technology will get left behind. And so I need to see my companies, even something that is a real estate, a restaurant business like McDonald's, I need to see them investing in technology. And that is just what they're doing. What else do I love about this thing? 44 years of dividend increases, almost going to be a dividend king. I love the Happy Meals. I think Happy Meals are a great way to get children involved with the company. And then when they grow up to adults like myself, they still love it. Multi-generational, all generations love McDonald's. And I love that it's just comfort food. Look, we're in the middle of a pandemic here, and yeah, it's good to eat healthy. And someone's commenting on my video the other day, like, it's not good that we're eating these Happy Meals and we're getting the toys there. It's not like we eat it every day. You know, we ration it. We have it once in a while. And yeah, we went to McDonald's a lot more during the Trolls promotion than we went to McDonald's more during the Trolls promotion than we have in the last 10 years. But look, Trolls promotion is over. We're just going very, very infrequently now. But it's that treat. It's a once in a while treat. And that comfort food, it's comforting during a time like this. And it's just something fun for the family. And so I see nothing wrong with going after some maybe less healthy food once in a while to enjoy oneself and have some comforting food. And so I love it for that. And I would imagine most of the world probably agrees with me because we see McDonald's consistently doing so well from an earnings standpoint. So what are some of the risks with McDonald's? Now, there are risks as with any company, and some of the big risks are healthier eating habits. We talked about this before. Will McDonald's adapt? Same as PepsiCo. PepsiCo, I would say, is probably even further ahead than McDonald's in that line of thinking. But I am sure McDonald's will adapt and continue to adapt. And yeah, a lot of people go there for the less healthy options. Shout out to the McFlurry. But people need healthy food as well. So will they stay ahead of that? Now, I think there's legal risk. Wow, this is becoming a theme. J&J, Pepsi, now McDonald's, legal, good grief. But there's legal risk here. And so there's a certain kind of oil extract that they use. I think it was called like palm oil or something like that they use in their food. Apparently it's coming from the rainforest, and there's this whole topic of deforestation. And again, I don't want to make light of one thing or another. It will be ultimately up to the company, governments, to strike the right balance, what's right. People need to eat. And so, but we also have to keep our rainforest as strong as we possibly can. So there's a lot of different stakeholders, and I think everyone needs to meet and find the right solution. But there's a critique of McDonald's that, hey, are there farming practices? They're feeding a lot of people here. The way they're going about doing that, is it what's best for our planet? And could there be some legal risk there? I don't know, but I've seen it being discussed. And so that's a risk factor. And I would say the other risk factor is, good grief, that PE is really high right now. And so there could just be some share price downside because it is trading a little bit aggressive. And I think the overall market believes that this pandemic is going to be over sooner than it will be. I really do hope that things get back to normal sooner, as soon as possible. But it just seems like that's probably not going to happen. And so I think the market has gotten ahead of itself here, and especially in a stock like McDonald's. I think 2021, for example, it ain't going to look as good as the numbers on the screen imply. The numbers imply a PE forward 2021 of 23.92. I don't think it's going to get there. I really don't. I think this pandemic is going to linger on, and I think it's going to be a much worse PE on current cost. All right, everyone. So that's McDonald's. I got to keep moving. I got a lot to go through. Also got a lot to say. As you guys know, if you've been around here a while, thank you for hanging in there, all of my long-term subscribers. If you're new to the channel, please subscribe. It's the best way you can support me. And I want to also mention, I now have a Patreon. I will link in the description below and in the pinned comment if you want to support me financially. that is one way you can do so for as little as $3 a month. I publish all my best content here on YouTube for free. I don't charge for any course, this or that. I keep those crazy affiliate links out of the videos, although no disrespect to those YouTubers who do it. It's just not for me. But how do I pay for it all? How do I keep things going? I do it through advertising dollars, but also through Patreon. So bless you all who have supported so far. I'm up to 50 patrons. I want to continue to grow that. Thank you, thank you, thank you. It really does mean the world to me, and it helps me do more videos more frequently with better quality content. So I got to move on to my number 4 favorite stock of all time. I want to talk about Clorox. So I'm going to share. Actually, before I share the numbers on the screen, I gotta look around because I got all kinds of stuff going on here. I have a few things to share with Clorox. Actually, no, I have one thing to share with Clorox. Here it is, Clorox bleach. So I got the big bottle here of the Clorox bleach. Bless this company. I love this company. I don't know how society would have gotten through 2020 without Clorox. We need the Clorox wipes. We need the Clorox bleach. It is keeping us safe during these unprecedented times. And so check it out on the screen right now. With Clorox, what do I love so much about this thing? Well, nothing about the numbers right now. Well, look, I'm talking about valuation, entry point. I don't love. I love the underlying numbers. Business is doing great. I own a lot of shares. I'm way up. My investment has performed well. But other than reinvesting my dividend, am I buying more shares at a PE of 33? Nope. It is richly valued, and with a starting yield of 1.9%, I cannot bring myself to buy more shares here other than reinvesting the dividend because I will not penalize a winner. Why do I love this thing so much? Clorox wipes, Clorox bleach, it is the solution. We will get out of this pandemic for a lot of reasons. One will be pharmaceutical companies coming up with cures and vaccines and things like that. Another, I think, will just be people acting smart out there, wearing their face mask and practicing social distancing. But quite frankly, what else? We got to disinfect everything, and Clorox is the solution. So God bless you, Clorox. And so what else? They own, I love this company because they own so many brands you probably would have never guessed. They own Burt's Bees. They own these Rainbow Light vitamins that I take. These are like these gummy vitamins. They have a Men's Energy. Works well for me. Keeps me going. And so I love those. They own Glad bags. I am such a fan of Glad bags. Kingsford Charcoal. So many more. They've got all these brands. Everyone thinks Clorox, oh, it's just about the bleach. That's that. No, it's not just about the bleach. Clorox is about a lot of stuff. And so I love Clorox. And so what are some of the risk factors with this company? As mentioned, extremely high PE. It probably has some room to come down from here. I don't think the PE that it's trading at now is justified, but I think everyone is flocked into this company because they make Clorox wipes. And Clorox wipes are sold out. You can't get it anywhere. They have a very low starting dividend yield. It's not really a risk factor, but I guess it is for someone like myself who aspires to live off of dividend income. I already used some of my dividend income to pay bills. Starting yield this low, generally not going to help me too much with paying bills, at least right now, but my future self certainly will. The concept of yield on cost still very much applies to Clorox, even at these levels. What is another risk factor? A lot of revenue right now is from the U.S., and so they have, I guess, country-specific focus. I don't think that's necessarily a bad thing, quite frankly. Maybe there is room for them to grow internationally, but I would say there's just a little less diversification with Clorox, but maybe it's not the worst thing. We're in this society now of nationalization. All these countries are kind of getting really patriotic and really nationalizing. You're seeing a little less globalization right now. Maybe that will change, but you see this kind of thing with just in the U.S., the way things are going with the kind of the U.S.-China tensions on the trade war. You see this with countries like the U.K. with Brexit. It's this idea of nationalizing stuff, and so just being kind of self-contained, if you will. And so maybe it is okay for Clorox. And by the way, one of the things I forgot to mention that I love about this company is their relatively small market cap. I remember when I started buying this thing, it was market cap was really low. It's like 11 billion or something like that, in that range. Now it's 28.7 billion. And so it's higher, but it's still very low in the scheme of things. And I tend to really value having a smaller market cap company in the portfolio, because smaller market cap tends to mean more growth opportunity a lot of the time. Although many large cap tech stock investors would disagree with that. Anyways, moving on. My number 5 favorite dividend stock of all time is an energy company. It is Duke Energy. Check it out right now on the screen. Now, no props for Duke. But hey, I guess the prop is the fact that I'm running my electricity right now and doing this video. I highlight a lot here at the metrics because I think there's a lot to love about Duke. Starting dividend yield of 4.8% is very attractive. The PE of 15 is very attractive. I think this thing is priced, and it's well priced, and it's a reasonable buy right now. It's in the buy zone for me, so I like that off the bat. What do I love about Duke? Reasonable entry yield, just mentioned. Reasonable PE, just mentioned. And I love that it's a regulated electric utility. Where this company operates, and they've got assets in the Carolinas. They've got assets in Florida. I actually entered this thing through Progress Energy. I own Progress Energy, got acquired by Duke. These are regulated electric utilities, and regulated means they have a monopoly on the markets that they're in, and that the price is regulated by the government. And so there's not going to be some other utility come in and say, hey, I want to offer electricity cheaper. No, Duke has the monopoly. And so I love that. I love a monopoly type business that the government allows to be a monopoly. That's pretty cool. So that's what I love about Duke. What do I dislike about Duke? Let's look into that a minute. There are some risks, as with any of the stocks mentioned today. Nuclear power plants. If something goes wrong with a nuclear power plant, that is very bad. That being said, there is a silver lining. A lot of proponents of nuclear these days are looking at nuclear as relatively clean energy. It is a lot more clean than something like coal, for example. That said, there is risk of catastrophe, and so that's something that Duke has to be very careful of, because if something goes wrong at a nuclear power plant, boy, that is going to create tremendous ramifications, very bad ramifications for society, for people that live anywhere near the thing, and obviously for the stakeholders, the shareholders as well. There's geographical risk to hurricanes. They live kind of in Hurricane Alley and hurricane territory, and so there's a geographical risk with the company. And I'm just going to say this, Dominion Energy, I don't own it, but man, what a joke of, boy, just with the dividend cut and with their asset sale to Berkshire Hathaway, I'm just saying it's kind of a joke these days, and it just sets a nasty precedent for the entire regulated electric utility market. And so basically Berkshire Hathaway, Warren Buffett wins, Dominion shareholders lose. That's at least how I look at it. Could something like this happen at Duke or at any other regulated electric utility? I think Dominion set a heck of a bad precedent for this particular category. So I want to move on. Oh boy. Number 6. Halfway through my list now on number 6. Oh, I love this stock. And so how am I going to do this? Let's start with the Cascade here. Did you know, Cascade, man, this is proud product of Procter & Gamble. And so I will tell you, I don't know if it's the pandemic. I don't know if it's because I'm kind of in my late 30s now with 2 kids, married, life the way it is. I find myself washing dishes and using the dishwasher multiple times a day. It seems like I'm always doing dishes, and I'll tell you something, we just go through Cascade. We just go through it. And so, boy, I love Procter & Gamble for that. But that's not enough. No. Thug life investing, I got to go big here. And so I don't just have the regular old Tide. I got the big Tide. And so Procter & Gamble, shout out. I love you, loyal shareholder. Thank you for making me very, very happy. If you've been here a while since the days back, I don't think this was maybe 2018, I think. I was just buying it up because it was on sale. Ain't on sale anymore. And so I bought it when it was on sale. But shout out and put in the comments below if you've been around here since those days. I love you. Thank you for sticking in here for the long haul. Anyways, let me share on the screen right now some cool stuff about Procter & Gamble. Metrics, nothing that exciting. It's fully valued, richly valued. Is it terribly overvalued? I don't think so. I think it's okay, but I guess it's nothing that I highlight. What do I love about it? We need these products to live. No matter what. Products like Tide, Crest toothpaste, Bounty paper towels, we need those to live. There's no other way around it. Global diversification, 56% of sales are international, and they're just a dominant leader in the space. Their market cap is $308 billion. Is just some small company going to come in and disrupt them? Maybe, but they will have the opportunity to buy up that company, which I like so much. And so Procter & Gamble has a lot going for them. That being said, there are real risks with this company, and the number one risk, we have not seen it pan out yet, but I think it could pan out, is Amazon. What if Amazon... Well, look, first and foremost, we know it. We're moving to a society that is more e-commerce focused. Especially the pandemic has accelerated things. People are scared to leave their house. They're buying things on Amazon. Amazon has control over their algorithm. What if they rank Procter & Gamble lower and put their own? What if Amazon makes paper towels? What if Amazon makes toothpaste? What if Amazon makes their own razor blades to compete with Gillette? They could do all of the above, and they could rank it higher, and they could also just do kind of more generic branded products and perhaps sell it for cheaper, because Procter & Gamble has brand names, and these are popular brand names, and there's a lot of marketing, a lot of expense that goes into that. So Amazon, I would say, is the biggest risk to Procter & Gamble, but we have not seen that pan out yet. So far, it has been just fine. And I think, quite frankly, there's room for everyone. And what I'll say, internationally, quite frankly, the population of our globe is increasing substantially. And there's going to be a lot more people needing these kinds of products to live their lives. Another risk with the company, could they lose customers to risky marketing? There was a Gillette ad a while ago. I've shared my commentary on it. I'm not going to go there again. But I know that it offended a lot of people. And a lot of people swore they would never buy Gillette products again. Personally, when I look at the metrics at the company, they've seemed to recover and have done quite well since that commercial. But my question is, could Procter & Gamble take some more risky moves in marketing? And next time they do a risky move, may it pan out bad for them? I don't know. But personally, in retrospect, was their move even that risky given where society is going? I don't know. I don't know. I mean, like I said, look, I'll get into it. At the time they did the commercial, I didn't have any problem with it. I didn't see anything wrong with it. And quite frankly, I think in the world of marketing, sometimes any kind of marketing, even if it's a little controversial, is good marketing because it gets your name out there. A lot of people here on my channel disagreed. Look, everyone should have their own opinion, but what we do know is that Procter & Gamble pushes the marketing envelope. They push it. And if they push it and they do something silly in the future that does not pan out so well for them, that's a risk factor. So what else is a risk factor at this company? There are disruptive competitors like Harry's and Dollar Shave Club. Now, one of their competitors that I also own bought Dollar Shave Club, but problem is disruptive competitors can come out of nowhere and can take market share from the incumbent. It will, and that's a risk for Procter & Gamble. Now, the silver lining there is if Procter & Gamble were smart, they would acquire some of these disruptive companies and use them to fuel their growth. All right, everyone. I'm already getting tired and we're only on number 6, so I got to speed it up. Let's move on to my number 7 favorite dividend stock of all time. All right, what is it? Oh, this is a fun one. So what have we got here? Oh, got the Diet Coke. All right, so my wife drinks this once in a while. I do not drink these types of beverages anymore. I gave up a few years ago due to health reasons, acid reflux reasons, and I have been better off for it given my personal health situation, but so many people enjoy them. We've also got the Diet Barks. This is the root beer, also a proud product of the Coca-Cola company. So going big with these. We've got a nice little stock of them here, just in case my wife needs a little extra caffeine and sugar to get through the day. Things can be busy with 2 kids. And so I want to share on the screen right now all the good stuff about Coca-Cola. And so unlike the last few, Procter & Gamble, Duke was good, but Clorox, not so much. I have a highlight again. It's nice to have something highlighted in this market. I like that they have a 3.6% starting dividend yield. That's great. And for that reason, I probably would be comfortable buying more shares of Coca-Cola here. Yeah, it is richly valued. The PE is high, but that starting yield is a good starting yield. And it's a good starting yield given where the market is at. What do I love about this company so much? I love that they have a high starting dividend yield. I love that they're a dividend king with 57 years of increases. I love that their margins are high. Man, when you're selling this, it is not a very expensive product. Margins are really, really high. And so net margins at this company are 24%. What I really love, and some of you may not know, I'm a real coffee fan. And look, I'm up late at night right now. Man, it's just how it is. Sweating, it's hot, it's in the garage. I do this for the culture. I do this because I love all of you. I do this for the patrons, the 50 of you on Patreon. I hope it increases who are supporting me. Bless you all. But all of you who are supporting through the thumbs up, subscriptions, comments, all that good stuff. Thank you. Just for watching it. Thank you. But what was I trying to say? I don't even remember. Oh, now I know. Coffee. I was contemplating, Ian, should you just do it? Drink a coffee before your video? I was thinking about it, but then I'm like, then I'm going to be up all night, throw off my sleep. So if I do seem a little tired in the video today, it's because I didn't do the coffee. But speaking of coffee, what do I love about Coca-Cola so much? They acquired Costa Coffee, and this is a huge, awesome, amazing coffee shop in Europe, and especially in the UK. Shout out to my homies from the UK. I love you all. Costa Coffee. I want to go back to London just to sit down there and enjoy some coffee. I'll tell you another brand that I love that you see in Europe, that you see in the UK, is this this kind of quick stop, healthy fast food place called Pret. This was acquired by a private equity company. Man, if I could get my hands on Pret and invest in Pret as a public company, I would be the first person to do it. I love that company. But I digress. But anyways, like I said, if I lived in the UK, I'm just telling you, day in, day out, I would just live. I would literally live and nourish my body with Costa Coffee and Pret. That would be my life. Anyways, man, I love this company, Coca-Cola. What are some of the risks with it, though? Health preferences. They sell sugar water. They got healthier stuff too. They got smart water. I got some here too. I don't have it in front of me for the video, but electrolyte smart water, good stuff, but that's a risk. What else? Unlike PepsiCo, which has such a amazing focus on snacks, Coca-Cola is all beverages. That creates more risk. Also, oh my God, Berkshire Hathaway. Those guys, Warren Buffett, got such a good deal buying those assets from Dominion. Kraft Heinz, we saw what happened there. Occidental, we saw what happened there. Berkshire owns 10% of Coca-Cola. Now, thankfully, I believe my interests are pretty aligned with Buffett and Berkshire's interests. That said, Warren Buffett, Berkshire Hathaway, very savvy investors. And who are they looking out for? They are looking out for themselves, and they're looking out for Berkshire Hathaway shareholders. And so Berkshire will always do what's best for Berkshire, not necessarily what's best for me as a common shareholder in Coca-Cola outside of Berkshire. And so I got to be aware of that. They control 10% of the company. They call a lot of shots at Coca-Cola. That's a real risk for me. I got to be aware of that. By the way, think about it. People have been asking me, what do you think about Bill Gates, Ian? What do you think about Warren Buffett? Warren Buffett and Bill Gates are good friends. They're homies. I'll leave it at that. All right, everyone. Moving on to the next stock. And so that was number 7 with these guys at Coca-Cola. I got to move on to number 8 right now. Number 8, favorite dividend stock of all time. Oh man, I have a prop for this very close by because I'm in the garage, but I am not getting up to do it because it's too late. It is my 3M blue Scotch brand painter's tape, but number 8 favorite dividend stock of all time is 3M. So let's talk about that for a minute. Bunch of stuff highlighted. I love the starting yield. I love the PE. For me, it's a good entry point in 3M now, and I am buying more. What do I love about it? Strong starting yield. 62 years of dividend increases as a dividend king. I love that they make those N95 respirator face masks. 3M is the solution to get out of this pandemic. It's as plain as that. I love them for it. I love them for it. And I think perpetually into the future, face masks are going to become more of a part of our culture. And I think businesses, governments, citizens are going to have to keep them on hand in case of an emergency. This is good for 3M, but it's also good that 3M is doing good by providing these types of products. What else do I like about them? I like their scientific focus, and I like that their products are everywhere, literally everywhere. Throughout my house, I use the Command products quite frankly, quite a bit. I like them. They're awesome. And so that's what I like about 3M. What are some of the risk factors with 3M? Cyclical industrial company. They are highly, highly cyclical, and earnings are way down since the cyclical peak. We're in a cyclical downturn right now. It's not an evergreen company. I look at some of these other companies that I talked about today, like Coca-Cola, Pepsi. They're consumer non-cyclical. Procter & Gamble, they'll do well in a good economy or bad. But cyclical companies, there's ebbs and flows because a lot of what they sell is business to business, B2B, and they're tied to the economy when companies are making investments. We know right now a lot of airlines, for example, they're not buying new planes, but we also know a lot of the components going into the airplanes are made by 3M, and so that hurts 3M. We know a lot of consumers right now in the middle of a global pandemic and economic catastrophe are not buying new automobiles, but we know a lot of the automobile parts that go into autos are provided by 3M, cyclical companies. So that's a risk factor. What else is a risk factor with this company? 61% of the business is international. And just because of the type of product they sell, being these films, these adhesives, these kind of things that I could see being manufactured by competitors in China, it gets me thinking. We got a trade war. We have some tensions. I hope that resolves. I believe, honestly, that global trade is going to lift all ships. I really do. I think it's important to be mindful of one's nation and one's country and to be patriotic, but also we don't want to grind a halt to global trade. I think that could have really bad ramifications on the economy and on the jobs market and on companies like 3M, because 3M relies on that globalization, that global trade. And so anyways, I think that's a risk factor because if things go the way they are, I could see something happening where China figures out how to make some of these adhesives and films themselves and doesn't need to buy from 3M, an American company. And so that's a risk factor. What else is a risk factor with 3M? Could these products just get reverse engineered? Could they get undercut somehow by a lower cost provider, a lower cost company, such as a Chinese company, for example? That is something that could be a risk factor with 3M. Nonetheless, with any stock, there are pros, there are cons. The rewards outweigh the risks. And so I love 3M, but with anything, I am aware of the risks, and I know that any one of my positions could face bad times or potentially very bad times. But in general, these 12 ride or die stocks, they are some of the best positioned companies in the world, in my humble opinion, after decades upon decades of the 2+ decades of research that I've been putting into them. All right, everyone, I'm getting tired, but I got to keep going. Number 9. Okay, I got some good props for this, and I go big here because this is Thug Life investing. So I'm going to go big, and then I'll go bigger. First thing I want to show you is Kleenex. Boy, seems like everyone's worried about getting sick these days. Pandemic, this and that. In America right now, it's the summertime, but it's the warm months, if you will, warm weather months. But when the winter comes, it's going to get cold. And when it gets cold, people are going to catch colds. They're going to catch the flu. They're going to catch all kinds of stuff. And we know the pandemic is out there. And so Kleenex is an essential product in our modern germophobic society that we all live in. It just is what it is. And so also, though, I love this one. As a parent, you would not realize this until you are a parent, but the amount of diapers that you buy and that you go through, it is staggering. And so check it out right here. I got the Huggies brand diapers. Big old box of Huggies, going big for the Thug Life investing. And this is a great quality diaper. I like the Huggies here because a lot of them are branded like Mickey Mouse, which is really cool. Anyways, got that. And so I'm talking about Kimberly-Clark. Let's share the stats on the screen right now for Kimberly-Clark, my number 9 favorite dividend stock. Excited to see the highlighting again. Starting yield of 3%. PE of 18.61. Hey, it's fairly valued, but I wouldn't say it's overvalued. And in this kind of market, and mind you, I think that the market is going to fall again. I don't think we're going to face a V-shaped recovery. I think the market could plummet again. And the reason I think this is, look at what's happening with this pandemic. It's stretching on longer than anyone would have thought. It's not getting better. California Governor Gavin Newsom just shut down indoor eating at restaurants again just after reopening. It's terrible. These poor people who just got their job back, then again turn around and lose it again. It's just awful. And I feel for the small businesses. And that's the worst thing. One of the worst things is seeing that. And anyways, I don't think we're going to see a V-shaped recovery, and so I'm ready for the stocks to tank again. But I'm just speaking about what exists now because I'm always averaging in whether stocks are up or down. But I am prepared if it tanks again, and I'll go heavy if it does. But with Kimberly-Clark, anyways, I'll share on the screen. Fairly valued, but a lot better valuation than some of the other things I've been looking at today. A lot of the other ones like McDonald's, for example, just really high valuations. I love the starting yield. I love the reasonable PE. I love that, hey, diaper demand, man, it's always going to be strong. Babies are being born. Babies need diapers. And internationally in particular, there's a lot of growth, population growth. And so I hope Kimberly-Clark can help meet the needs of those growing populations internationally. Kleenex brand I love. It's just iconic brand. So what is a risk with Kimberly-Clark? Amazon white label brands. We talked about that. Could Amazon disintermediate these big brands? Oh, yes, they probably could. But so far, there's been room for everyone. Could there be increased controversy and just difficult sourcing paper? This is a paper company. Their products are generally made from paper, and as similar to the line of reasoning with rainforests and with McDonald's, could the same line of reasoning apply to Kimberly-Clark? I think so. And so in a society that becomes more environmentally conscious and we start thinking about the trade-offs between, hey, there's a real need for diapers, there's a real need for Kleenex, but hey, there's also a real need to maintain our earth and keep everything nice and green. How do the two coexist? That could affect these folks over at Kimberly-Clark and shareholders like myself. How much more growth is really ahead? That's kind of the last point. The last risk factor is I think their growth will largely be dependent on international, and how could their international market share dry up a little bit because of this concept of nationalization or nationalism that we talked about earlier. Got to move on a little quicker. Getting tired. Got to close this thing out. Number 10, though. Oh, man. I love it. Starbucks. Unfortunately, I don't have a prop right now. I'll jump right into it. I love Starbucks. Nothing is highlighted because it's ridiculously overvalued here. Yet people ask me, Ian, why do you buy every Monday? I do it for the culture. I just do it, quite frankly, for the culture. I don't care what it's trading at. I buy it because I buy it. I love it. It's as simple as that. Why do you buy it, Ian? You're paying too much money, this or that. I don't care. I buy it because I love it. What do I love about it? It's become a necessity. Maybe it's different where I live than where you live, but I don't care what kind of job you have, how much money you make, what your financial status is. Starbucks has become a way of life in the Bay Area, in California. People need it. I love that. I love that all generations love it. I was at lunch with my wife today. We were celebrating our anniversary, and it was so exciting to see when we were sitting outside at our favorite restaurant, just some kids walking down the street. And I asked my wife, how young are these kids? To me, I thought they were like 10 years old. And she's like, no, they're probably like 13. But they all had their Starbucks cups. And I'm like, wow, when I was a kid, that's not how it was. Like kids, I wasn't drinking like caffeinated, like that kind of caffeinated beverage. I was drinking COCA-COLA, but I wasn't drinking like a coffee type drink. I'm like, man, things are changing. And you think all generations love this thing. And that's why I love it. This company has got a bright future, many, many decades into the future, many generations into the future. What else do I love? They are an amazing third place. I always relied on Starbucks to be my third place. And third place is a concept they coined. It means you're not at work, you're not at home, but you need a third place that's comfortable to hang out, to be with friends. Come on down to Starbucks. We got to get rid of this pandemic so that third place comes back. And this very benefit of the company, this thing I love, could be a risk because they have all these restaurants that they're leasing, and they generally don't own their real estate like McDonald's. It's not a real estate play like McDonald's. It's a brand play. It's a coffee play. Are they going to have to downsize if this third place is no longer a viable option? We shall see. We got to get rid of this pandemic, everyone. I also love their quick growth in China. They are growing quick in China. But there are risks there with this nationalism and with tensions on trade wars as well. So what is a risk with this thing? There's a few. Pandemic continues. This company may have to cut the dividend if the pandemic does not cease, because this is a bad year for them. It's a bad year. Terrible 2020 PE. Will the third place concept get challenged if the pandemic persists? And they don't own the real estate, generally speaking, the way McDonald's does. And so those are some of the risk factors with Starbucks. So moving on, I want to talk about the Home Depot. And now I'm on number 11, so we're getting there. Number 11 favorite dividend stock of all time. Check it out. Loctite. I just bought this sealant the other day. This is a good product. This is the polyurethane sealant for the roof and the flashing. I needed some of this. Recently installed a gazebo, and with the gazebo, it has some screws that needed some caulking on it to keep rain out. And so anyways, I bought this, and now what was so sorry, my friend Sam, if you're watching, this is not a RPM product. Loctite is a competitor, but for the roof flashing sealant caulking, this one I thought would be the best, the Loctite brand. But anyways, I generally am a fan of the DAP brand and those RPM products that I covered in a recent video. I'll link in the description below. But my experience at Home Depot was awesome. What happened is I ordered online. I showed up in the parking lot. I parked in one of the designated spaces for pickups, went on my phone, and told Home Depot I was there. The nice man comes out with my bag of goodies. I take it in my car and I drive home. And so Home Depot is innovating on a technology front for that experience, not having to go into the store. And man, I love that. I love that because I'll tell you, as a homeowner, whether I like going to Home Depot or not, I'm just going because I have to go. And that's kind of one of these businesses. Why do I love it so much? I love it because people have to go even if they don't want to go. So check it out on the screen right now. I don't have anything to highlight on the metrics because it's fairly valued. It's fairly valued. I'm not buying here, but I bought a really cheap tranche back in March when things tanked. I love it. But I'm always there. What do I love? Always there, even if I don't want to be. It's pandemic proof so far, which is great. We're seeing that in the numbers and sales. Online is growing. It's up consistently 20% year over year. It's still small. It's only 7.9% of sales, but it's growing. And so I like their online innovation. I love the parking lot delivery. What are some of the risks, though, with this company? What are some of the risks? It's just a middleman big box store. So the value they add here, it's going to be on the tech and experience front. And quite frankly, the second risk is this experience. I love the experience I just mentioned. Showing up buying online, showing up in the parking lot, getting my stuff, not even having to go in. Why do I like it so much? I don't know about you, but I'll tell you. If I go to Home Depot at night before the pandemic, good experience. I walk in, no one's there, have the store to myself. It's a good experience. But most of the time, if you go to Home Depot kind of in the middle of the day, it's busy, it's confusing, it's kind of not that inviting of an environment. And whenever you need help, I'm not trying to put anyone down. I'm sorry if you work at Home Depot. I don't want to put you down. But a lot of the associates, at least in my local area, you can just tell they're not really into their job. They're not always helpful. Sometimes you get a really helpful person, but a lot of time, no, not so helpful. It's kind of a crappy experience. And so that's what I'm saying, but maybe there's room for improvement. And I think at this point, in any other business, if the experience were kind of like Home Depot in-store experience, maybe the company wouldn't do so well. But I think it's doing well because people just have to go there and there's no other alternative. And so that's a good position to be in. What else is a risk factor? They tanked during the great financial crisis. They lost half their value of the stock. But since then, it's up multiple orders of magnitude. And so we'll see. During the pandemic so far, it's been doing just fine. But will that continue? We shall see. Closing it out, everyone, with a real estate company. This is Realty Income, ticker symbol O. Check it out on the screen. I don't have any props for this one. It's a real estate company. I highlight two metrics. Dividend yield is a healthy, or it's a distribution because it's a real estate or investment trust, but it's a healthy 4.9%. And the 2019 trailing PE, I do this on AFFO, adjusted funds from operations, is a 17. And so fairly valued, if not undervalued. There's some risk there. There's heavier risk with this probably than some of the other companies I mentioned today. But at a 4.9% yield, I think it's a good entry point for Realty Income. So what do I love about this thing? Monthly dividends. It's the monthly dividend company. I love that their portfolio occupancy is at a strong 98.5%. It's a triple net lease company. And so this company owns real estate, but they pass all the responsibilities of managing the real estate down to the people that lease the real estate from them. And they tend to lease to really high quality companies like Walgreens, for example, the Home Depot, for example. FedEx has a lot of distribution facilities with a Realty Income. Taco Bell, for example. And so they've got some great tenants and their occupancy is really high. They're shareholder focused. Since 1994, when they started listing on the NYSE, their compound annual growth rate, all in with dividends and everything, compounded over time is 15.3%. They brag about that on their website. That is really strong. And they give so much exposure to commercial real estate without the exposure of managing commercial real estate. As someone who works in commercial real estate, I can tell you there is a lot of overhead and responsibility in managing commercial real estate. So it is oh so nice to outsource that and own it through a REIT. And so that's really cool. What are some of the risks of owning this company? They have big exposure to fitness clubs and movie theaters, 7.2% fitness clubs, 6.3% movie theaters. And so those are two industries facing a lot of challenge right now that are basically closed down in California because of the pandemic. They have pandemic exposure just being in real estate. And I think they not only the pandemic, but as we emerge from this pandemic, there could be some changes in how real estate is approached. I know in the Bay Area, at least where I live, a lot of the companies are starting to tell employees you can work at home as long as you want. And how will this affect office space? How will this affect the future of real estate? Thankfully, a lot of the real estate that Realty Income owns is not necessarily office space. I'm sure they have some of that, but where they also focus is retail. They own there's always going to be Walgreens locations. There's always going to be Taco Bell locations, and they own a lot of industrial buildings too, warehouse buildings. And we know direct to consumer, talked about PepsiCo, snacks.com. You need warehouses to house that merch. By the way, you want to support my channel, I also have custom merch. I'll link in the description below. Check it out. It's really fly. It's really cool. Anyways, I think Realty Income has a really diverse portfolio. That being said, there is risk long-term being in real estate these days, and you have to be in the right pockets within real estate, within commercial real estate. All right, everyone. Thank you for watching the video today. Long one. Those are my top 12 favorite dividend stocks of all time. Share in the comments below if you like those stocks as much as I do, or if you have different ones that you love. Share your top favorite dividend stocks in the comments below before I leave today. In terms of a full disclosure, I own all of the stocks mentioned today. I am long Johnson & Johnson, ticker symbol J&J, PepsiCo, ticker symbol PEP, McDonald's, ticker symbol MCD, Clorox, ticker symbol CLX, Duke Energy, ticker symbol DUK, Procter & Gamble, ticker symbol PG, Coca-Cola, ticker symbol KO, 3M, ticker symbol MMM, Kimberly-Clark, ticker symbol KMB, StarBucks, ticker symbol SBUX, Home Depot, ticker symbol HD, and Realty Income, ticker symbol O. I own all of those in my personal dividend stock portfolio. Also, very important note, today's video is not financial advice. I'm not a licensed financial advisor. I'm just sharing my journey here on YouTube for fun and entertainment. Before investing in the stock market, please consult a licensed financial advisor first. Investing in the stock market carries tremendous risk, and especially the way things are these days with the pandemic. Literally just sharing my personal journey here on YouTube for fun and entertainment. I love you all. Thank you if you made it to the end of the video. Comment below. Give me a thumbs up. If you made it to the end of the video, love you all. I will see you in the next dividend investing video.